It's really about supply and demand. Ultimately, that's what our entire society really revolves around. But this is something that I'm not sure how many people might be aware of these types of data and these types of trends that have been in development for a number of months. Now, of course, let's look at that silver trade. This is kind of crazy. Welcome to the Tactical Edge, a show that sorts through all of the noise and commotion out there in an unrelenting pursuit of the signal. Thanks for joining us.
Raj Bhuyan is a managing partner of Tactical Wealth Management. Advisory services are offered through New Edge Advisors, LLC, a registered investment advisor. Opinions expressed and information shared are for informational and educational purposes only and should not be considered as a solicitation for the purchase or sale of any security. Please consult a tax or legal professional for any specific information related to those topics. Past performance may not be indicative of future returns. Investing involves risk and the possible loss of principal capital. For those seeking additional information, please visit our website at tacticalwm.com and contact us.
Welcome back to the TWM Tactical Edge podcast. I am Raj Bhuyan, a managing partner at Tactical Wealth Management, and it's hard to believe that we are already into the second month of 2026. It's been quite interesting to watch the tape so far this year, so much so that we think this is a good time to refresh our market bias, and that'll be the focus of this episode number 6. And why not use this quote from Rudy Havenstein, or kind of a supposed quote? He was supposedly asked this question, why haven't you gotten a new suit? Here he is in the early 1920s, the president of the Reichsbank, in the middle of a huge money printing operation to pay back all these reparations post the Treaty of the Versailles. And he quips supposedly by saying, I'll wait for the price of a new suit to fall before buying one. Now, this was in early 1923. Going back to the early 1920s, 4 of these 20 mark quarter-ounce gold coins would equal a double eagle U.S. gold coin. That was about 1 ounce of gold. And at the time, going back to the 1914, 1915 range, you would have this 20 mark quarter-ounce coin equal to pretty much a 20 mark note. And they were interchangeable for a long time until the gold standard was basically abandoned during World War I. But by the time we got into 1923, one would need something like 4.4 trillion of those 20 mark notes to be able to acquire that 1 quarter-ounce gold coin. And I don't think that Rudy probably got the price he was looking for if, in fact, he did seek to buy a new suit. As Ernest Hemingway has said before, it happens gradually and then suddenly. Now, let's get into the market bias. Number 1, let's give a right tail update. It's been a few months since we've talked about the right tail in this podcast. We also talked about it a year and a half ago in our newsletters and with our clients. And the whole thesis is pretty much, it's very similar to the debasement trade thesis, just a different vernacular. And that is, for the most part, a lot of the increase in these assets, including home prices and equity prices, and of course, precious metal prices, are really more of a release valve for all this incessant money printing and the underlying devaluation of our dollar, along with a lot of other currencies. With right tails, though, if this is kind of playing out, we do typically would see much more volatile markets, and we haven't seen that as of yet. So that is still something where the jury is still out. We're not sure we really are in this right tail, essentially, world. But if we are, then we believe this is the time to basically make sure someone has a tool set to potentially navigate a perhaps much more difficult, but also very opportunistic environment. When we go back to September for our first podcast episode, we'll update these numbers on these best performing stock indices. Here we go. We have Venezuela, Zimbabwe, Argentina, Lebanon, Turkey, Nigeria, and India. These are places where the underlying currency has really had a lot of headwinds. And so you get these supersized annualized returns on a nominal basis, mainly because the denominator in these countries is falling. Let's focus on Argentina again. We've done it before. So in the last 6 years, Argentina has annualized at 142% with an official inflation rate of around 82%. Even with that 142% return, the Merval is still lost to the price of gold when priced in pesos by about 1.5% a year the last 6 years. And look at that standard deviation, about 3 times or more higher than the standard deviation of the US stock market. Now, let's look at this hypothetical 3 baskets of investors. Basket number 1, investors who put all of their assets under the mattress priced in pesos. How did they do over the last 6 years? As you probably already know, not very well. Their pesos lost about 99% of their purchasing power when priced in gold. Now, investors in basket number 2, they put all of their money in the Argentine banks in pesos, but making something like almost 50% a year on average over the past 6 years, and they still lost 87% of their purchasing power in price in gold. Now, basket number 3, those investors that put all of their money in the Merval index fared a lot better. They only lost about 9 or 10% of their asset purchasing power, but they had to endure unbelievable amounts of volatility. So let's dive into that a little deeper. If we go over a quarter century and look at the returns of the Merval, this is a log chart, by the way. A nominal linear chart would look just absolutely goofy. You have a return of 40% just about over this 26-year period. Now, inside that, you also have this volatility. And so how do we kind of illustrate what the volatility may look like? Well, you get this normal distribution returns when you look at large groups of numbers. If I look at the US stock market returns over almost a century, and I look at rolling 12-month returns, I get something that looks pretty symmetrical. And that's what the bell shape's all about. However, when you get right tail events, you get a distribution that also resembles something with a long right tail. For instance, if I look at the Merval index and I take the same deal, I do 12-month annual returns and roll them over about a 26-year period, here's what that distribution table looks like. You see a very long tail on the right side where you have outsized annual returns of 200, 300, 400, even 500% in some occasions. And here's that distribution that looks like a thing of beauty. And so the problem is when someone looks at, they see these returns, they're saying, wow, I would love to get 200 and 300% returns on an annual basis. And I'd say that's great as long as you don't have to go out and buy some bread or some milk, because that's where it would really get you. And so from our standpoint, we think that not necessarily the US is going to go through something this extreme, certainly, but we do think there could have some elements of rhyming along these lines, especially if the policymakers continue this path of kicking things down the road, printing more money, and also hoping that the rest of the world continues to look at US as the reserve currency that it has been for much of the last 80 years. Now, with regard to the volatility over this 25, 26-year period, here we go. Here's the problem with these drawdowns. You're looking at almost 30, 25% plus drawdowns over this period. And once you go over 25%, that's what we call the danger zone. That's when people behaviorally have made poor decisions. When they lose 20, 30, 40, 50 plus percent in just a short amount of time, this is when they might want to check out or change the path, change the strategy. And a lot of times these strategy changes don't quite happen at opportune points in a market cycle, to say the least. So how is the US dollar doing? If we are going down this road, what we expect is the dollar the first sign. And I think dollar is actually a very good first place to look to see, in fact, if the US is kind of going down in this direction. So if I look at the dollar index, something has changed in, let's say, the last 8 or 9 months. If we go back to 2008, we've seen the dollar index rise along this really nice parallel channel, pretty much making higher highs and higher lows. But more recently, we've seen a 10% decline in the dollar index, where it's at the bottom range of this ascending channel. And if it were to break below this channel and continue to fall, we now want to consider the potential implications. So we like to look at historical analogs to give us some insight of what could happen. Obviously, there's no guarantees in that matter. So let's hone in on what happened between 2000 and 2008. You have something like a 40% decline in the dollar index. And with that, you had a relatively poor performance from the US large cap indices. The S&P lost 1% annualized, the NASDAQ lost 3 1/3 annualized, while energy, you had precious metals, international stocks, and small cap stocks do decidedly better. If we find another analog of such a big dollar decline, we have to go all the way back to the 1970s. And during this period, we had the dollar index from 71 to 80 lose about 29%. Now, over this period, we also had large cap US stocks underperforming, where energy, precious metals, and to a lesser extent, international and small cap stocks did exceedingly well in relation to large cap US stocks. So what we learn here is that if we see some more depreciation in the dollar index, we should not necessarily expect large cap US stocks to be the leader on a sustained basis. However, most investors here in the US are very overweight US large cap stocks, really because the indexes that are most popular, like the NASDAQ and the S&P 500, are very cap weighted, and they are now highly concentrated in the biggest companies, as we've already talked about on occasion in previous podcasts. Now, number 2, segments of the markets are stretched and valuations are at extremes. And yes, I said this about a year ago, and things have gotten even more stretched, but there has been a change to a degree with regard to the relative trend. Let's dig in. If we look at the 17-year cycle, this is nothing new. It's very extended. It's at 14.75%, which is awesome if you've been an investor in equities in the United States the last, let's say, 10 years for sure. But we now have a situation where you wonder, if someone were to retire and maybe have a liquidity event and get invested back in 16, should they have the same portfolio construction as someone who maybe have retired, let's say, in 1999 or 2000? Should those portfolios look the same, or should they potentially look very different? Or should the mechanisms by which risk management is employed, should those be different as well? We're not going to answer that question, but I think you know where we're going here. If we look at valuations using normalized earnings, again, we are basically off the charts. This is great if you've been an investor, but does this mean it's going to be a great time to be an investor in, let's say, passive investments that are cap weighted for the period going forward? This is where we think it would be a much more challenging environment, just generally speaking from that standpoint. If we look at the percentage of investors that are all in, they're all in. This is the most US investors have been in financial assets that are equities since the Federal Reserve's been keeping records going back to the 1940s. And if you look here at other times when they were high and were way higher than they were before, 68 was a bad time to be a US investor, basically in passive indices, and certainly 2000. Conversely, in 09 and 82, when investors had relatively low weightings to equities, were great times to be a basically index investor from that standpoint. I have to put in the allocation to gold here just to show you how different it is from that standpoint. So if we look at the allocation to gold by investors, you see something that's pretty amazing. Even though gold has outperformed the S&P for the last 25 years, you still have weightings to precious metals about 90% below where they were in 1980, when gold made its last major peak at about $780. That is quite telling. Now let's look at the scoreboard. Scoreboard updated, looks pretty scary, but it doesn't mean the stock market's going to go down necessarily. Because remember, the stock market, if we look at the pricing, is still a ratio. And this is what we explained to be part of the great returns we've already seen. And if this liquidity funnel continues, this could help propel stock prices higher. But like I said before, with other types of markets, we've seen right tail events occur. We typically have a lot of volatility to which most people may not be prepared mentally or actually mechanically for such type of an episode to play out. So what's changed? Well, here's what's changed. Let's pull up the FANG index now. So the FANG index is the big cap stocks here, and we have the nominal FANG and we have the 88-week moving average. And here's this time in early 2025 in April where we came back down to that moving average, bounced off of it. This was a great risk reward point to basically be adding more fuel to the fire if you were inclined to do so. And look at the flows out by individual investors, by the way. Individual investors were selling their ETFs at that time, but I have to give them credit, they have come in pretty hard with a lot of new asset flows. But the flows have gotten so high using 15-week rolling flows here. This is the highest we've seen in a better part of a decade. And typically when flows get this high, it's usually not a good time to be an all-in investor because this is really more about the responsive nature of how flows work. The flows are usually responding to an environment. They're not necessarily being proactive from that standpoint. So if we look at this again here, and I now overlay the international stock market and look at this through a ratio. So let's go ahead and basically put a ratio of the FANG over the international stock market, the all country world ex-US, and you see something very different. You see a ratio that actually made a high really early in 2025, not certainly in the fourth quarter, and also one that is broken below its 88-week moving average and actually falling here. This is something that might be news to a lot of investors, but this is, to us, a very important element to understand. The marketplace is kind of telling us that something could be changing here. Now, can this come back and rebound? Certainly. But as this turn, if it were to turn lower here, and this ratio starts turning, now we have probabilities at our side suggesting that this could be something that could be quite sustainable in nature. If we update the FANG2 over the FANG 0.10, this is what we showed in our last podcast, even with that 2-day decline in precious metals at the end of January and the beginning of February, we have a little tick below here, but we still have something that structurally looks pretty good here. And if we have something that pulls back, we have now something that we can work with and look at this ratio going back about a decade and plus. This is still very early in the game from that standpoint. We don't have to be in the first inning, even though we've been in these types of instruments. People don't need to get in the first inning of the baseball game to really have some nice alpha generation over the course of a market cycle, potentially. Now, let's look at this ratio and flip it upside down. Sometimes it's really insightful to take these types of visualizations and kind of just flip the axis. And if we flip the axis, we have something that looks a little more ominous. This is the FANG on the upside, with the FANG 0.2 being the denominator. And we see this descending triangle where we ultimately break below here in early December of last year. And yes, with the pullback in precious metals, we have a little bump here, but this is quite troubling. This is suggesting that we are in quad D in this type of ratio from the standpoint of the FANG 0.10 stocks being on top. This here, especially if people are overweight US large cap tech or US stocks in general, this is something that people might want to consider, especially if they don't have any type of risk management or cash on the sidelines, generally speaking. Now, let's go to the other side of the equation. Let's look at the precious metals markets. We've had this really strong ascent in 2025 with precious metals rising over 150%. We've seen a really nice pullback here in the last couple of days. And we are still, however, 80% above the long-term moving average. This is still a little frothy just from a trend standpoint, even though we might be very bullish in the very long term. So this is something where we have to find ways to try and navigate this, because usually these will close in. Hopefully we see something, if you're a bull, it's a little more of a digestion phase and it kind of goes back and forth, rather than having something that kind of comes right back down to where it was just a few months ago. If we now look at this precious metal market divided by the S&P, you see some very encouraging signs for the precious metal market. And that is, even with decline as of late, we have this ratio solidly in quad A. It's in a structural bull cycle when the S&P 500 is the denominator in this ratio. This is telling us to own more precious metals and less S&P, generally speaking, depending on your risk tolerances, etc. But this is something that I'm not sure how many people might be aware of these types of data and these types of trends that have been in development for a number of months. Now, of course, let's look at that silver trade. This is kind of crazy. Back in our last episode, when silver was at $77, I believe, we were like, wow, this is like very extended, very parabolic looking. And what does it do? It goes straight to 118 change. Now, we've come all the way back down into the upper 70s the last couple of days. So that is a 30+% correction on just a few hours of trading. Still, however, we have something that is still quite compelling, and that is a very, very strong breakout of, we're talking a multi-decade pattern, basically going over for the better part of half a century and then having a really sharp breakout here. So yes, does silver need to kind of buy some time for a while? And I would say, being relatively bullish, we'd like to see something that's more of a high level consolidation, but we have to be prepared for just about anything here. And as something climbs higher, there might be opportunities to find ways to diffuse some of the volatility in these types of instruments. Okay, now what inning could we possibly be in? We're going to use the KISS plan, the Keep It Simple Stupid plan, which is all about supply and demand. Ultimately, that's how our society revolves. And if you look at the growth rate in the production of gold, or the extraction of gold out of the Earth's crust, you can see that there's been a multi-decade decrease in the growth rate down to 1 or 2% compounded. This is why the policymakers hate the yellow metal, because they've been growing money at better than almost 9% a year ever since the United States went off the gold standard in 1971. And that 9% is a lot faster than the growth rate of the economy for sure. And of course, magnitudes larger than the growth rate of gold being extracted out of the ground. And of course, this is how politicians buy votes. This is how politicians get things done when it comes to all the social programs, or maybe even military programs that they really have higher in their priority list. The problem is there's just too much money sloshing around from that standpoint. So looking at the inning, where do you think we might be? Well, here are a couple ways to take a look at it. If we look at the valuation of gold today vis-a-vis the global stock market capitalization, we are nowhere close to where we were in 1980, even when gold was only at $780. The price of gold would have to basically go up fourfold and have the stock market flat for this ratio to basically be equal to where it was about 45 years ago. On top of that, if we look at the equities inside the gold sector, the mining equities and how they have done in relation to the S&P, they had a tremendous back and forth conceivably, but tremendous return to the upside from the late 60s to the early 1980s, about 14-fold better than the stock market. And then, of course, you've had this very long cycle of underperformance for the most part for much of the last 5 decades. Now, with this really strong performance last year, we're seeing this ratio actually rise. This is still early in the game. Virtually no one owns any precious metals across the country, generally speaking. And the precious metal complex would have to rise 16-fold in relation to the S&P to get back to its old cycle high back here in 1980. If we zone into this type of chart in logarithmic terms, we'll see that we haven't really even broken out. So the question is, what would be the main, let's say, kryptonite that would be something that could really weigh down the precious metals markets while it's trying to break out of a multi-decade downtrend? Well, ultimately, it comes down to positive real rates. If the Fed really gets tight and does anything like what Chairman Volcker did in the late 1970s when he took interest rates up to 20%, or more importantly, 2 and sometimes 2.5 times that of the official inflation rate, that's really would kill the gold market from that standpoint. Number one, you'd be getting paid very well on your interest, and two, you would be defending the US dollar. The problem is, with almost $39 trillion in debt, the US government simply cannot afford to take interest rates much higher to defend or fight against inflation in a material way. And that is essentially the crux of the matter. We even have talk of a new Fed chair and how he might go down this road that looked like we were pursuing a year ago early on in the administration, with this fiscal austerity path, ripping the Band-Aid off, ending QE, and really going for a stronger US dollar. The problem is, this is very politically inexpedient, if I can use that terminology, meaning that this would ultimately lead to much higher unemployment, lower growth, lower equity prices, really a scenario that Congress people would essentially really fear, because they have to get elected every 2 years. A third of the Senate gets elected every 2 years. And having a economy going through maybe a needed contraction, you can make the case, and really cleaning out a lot of the froth in the system would probably take too long. And we're talking 2, maybe even 3 election cycles for that to really play out. And we don't think the world is in a place to actually have the patience for that to unfold. So we're kind of stuck from that standpoint. We're kind of stuck in this game where if we pursue this type of path, even though it might be the right thing to do, like I said, to clean up all of the basically misgivings and the bad policies, etc., it probably would lead to a very sharp contraction in overall economic growth, even in the short term, which could cause a lot of volatility from a political standpoint, to which we're not sure if the politicians are really up or brave enough to handle that type of scenario. Going back to our baseline, we still think it's the 1970s is really the closest analog to the environment that might be in front of us. What did the best? As you might already guess, precious metals had a really good run in the 1970s, 13-fold better than the Dow Jones. The energy complex was up almost 18-fold better than the Dow Jones over the time. And to show you how massive these relative returns were, if I throw in the NASDAQ's outperformance of late, which is about 3.5 times better than the Dow, it is simply dwarfed by the precious metal and energy complex in the 1970s. Okay, so let's leave you with this one last thought. We have this Dow gold ratio, to which we referred to in the past on a number of occasions. A lot of folks have been talking about it. What really is it? Well, it's really this battle back and forth between human ingenuity, economic growth, basically increased standard of living for the masses, captured energy, with nature's version of ingenuity, essentially. We need this very complex set of events to occur in order to have the energy release to create all of these heavy neutron-rich elements. And so I call it cosmic ingenuity. They're tangible and rare stores of value, but they can be used throughout a multi-decade market cycle as a way to kind of check when humanity kind of goes astray. When we get a little too greedy, maybe a little too much froth in the system, a little too much fraud in the system, a little too much money printing. We have this move towards what's real, what's tangible, and what's really, truly rare. And that back and forth is very interesting to look at if you look at it on a long-term, multi-decade cycle. If I throw the Dow gold ratio up going back to 1900, you see these patterns, very insightful. You have 1929 high and 18 times. This is telling you need 18 ounces of gold plus to acquire one share of the Dow Jones. It goes down to 1.8 and change in 1932. And here's the back and forth. With a top in 1999, and even though the Dow has recovered substantially on nominal terms and is on the precipice of coming towards 50,000, we have this ratio that's been falling for the last few years. And no one knows if this ratio is going back to the low here or if it's going to turn around and go higher. But the question might be, what if it continues to fall? Are you prepared for that? If you do see it fall, or are you even monitoring it? Because their implications are profound, we would argue, if this ratio continues to decline. Because, as we said before, most folks out there are simply not positioned for what could be in the works. So that's all we have for today. Obviously, we believe that the cruise ship model is a tired old model. This is a huge cruise ship, by the way. And obviously, in the environment we see coming forward, a speedboat might be a better vehicle. And from that standpoint, we will certainly put together some more podcasts. We really enjoy putting these out. We appreciate all the feedback we've received. And in the meantime, stay vigilant out there, and we will be in touch.